So today I'm sitting down with someone who has had a front row seat for over 2 decades now, and that's Matt Mieras. He and his team have closed over 3,500 loans in total volume at around $1 billion just in the last 5 years. So figured we need to speak with the right individuals who actually fund what's happening within the entire market. And this is Ask Charleston, so let's get into it. Matt, welcome.
Yeah,
Welcome. This is Ask Charleston.
yeah, thanks for having me.
Yeah, absolutely, man. Well, I wanted to just go ahead and get started and kind of set the table for everyone who you are, what you do, and who it serves.
Okay, sure. So I'm Matt Mieras with Guild Mortgage. I've been a mortgage lender for in 23, 24 years roughly. We serve the Charleston area, but we also are licensed in the Southeast, so we can help in multiple states.
Yeah, thanks for that, Matt. So here's where I really want to get us started. And because I think a lot of people that are listening to this or watching this might have a preconceived notion that the idea around real estate is that the agent is the one that actually, sells the home.
Mhm.
But in reality, it's not just that the lender's on the back end of everything doing a lot of the paperwork. You guys are the ones that actually make all of the buying and selling come together, right?
Mhm. Yeah, yeah, absolutely. Like our job is really an advocate to speak with the client about their financial goals, understand their financial situation, their background, their hopes and dreams, and kind of structure it and give them a picture of how it's going to look. So that way, when we hand them back to you as the agent, you can take it from there.
Yeah, that makes sense. Well, let's take that one layer deeper because I think that most people have really never had the entire mortgage process explained to them from
Mhm.
start to finish, or even before the start, if that makes sense.
Okay.
So, walk us through what actually happens when someone either comes into your office and sits down with you, or you speak with them from the very beginning on the phone.
Okay, sure. So, really, to the initial point of conversation, the goal is what we call in our industry is like a hopes and dreams meeting or call. And the hopes and dreams call is really to identify five or six different like targets, so to speak. We want to know what part of town you want to look within. Are you looking for a single family home, a townhome, or a condo? What county you want to be within? Your sales price, your monthly payment goals, your timeline, and then your financial expectations for out of pocket costs for down payment, closing costs. Because all that information tells us, it paints a picture of how we should structure your financing. So after that meeting, we're going to provide you with a recap. The recap's going to say, "Hey, Brett, this is what monthly payments look like in Summerville for this price point. But more importantly, here's a payment chart to follow, so you have an idea if you see a $300,000 house or a $500,000 house. We want you to know what that payment's going to look like. We're going to provide you with an estimate of closing cost, a pre-approval, and then a checklist of what we're going to need for your approval. And ultimately, the goal up front on our end is to answer any questions that someone has up front. So that way, when we turn them back over to you as the agent, all their questions are answered. So if they see the right house, they can make an offer and have the confidence of knowing that they know what their payment's going to be, they know what their out of pocket expenses are going to be, and they know they're making a fundamentally strong decision.
Yeah, that's awesome. And I can even speak from the agent side and experience when someone has not had that conversation,
Mhm.
and it's my own fault. Have started showing properties with some folks, and
Okay.
then we find the dream home. It's perfect. They know where the Christmas tree is going to be and their couch, the whole 9 yards. And then we get on the phone with you, and everything totally changes, and now that home is no longer on their list.
Sure. Yeah.
So what are the right things that a buyer should be doing, and how far in advance should they be considering some of these things?
Yeah, I'd say probably 6 months in advance. You really want to take some time to get together your financials, so to speak, as far as what can I afford? Because those are the most important things. As far as if you're paying rent right now and it's $2,400 a rent, and you say, hey, we're really comfortable with an extra up to $400 a month. Those baselines tell us what price point you're going to end at from a sales price perspective. So again, just kind of sitting down, going through your financials. Okay, here's my emergency reserve fund. here's how much money I have to use towards the purchase of a home. Because defining that baseline is so important for us because it tells you how to structure an offer,
Yeah.
right? If someone comes to us and says, hey, I have the down payment and closing costs, but it's going to tap all of my assets. Well, then how do we arrive at just the down payment? So again, that's the situation where I could say, hey, Brett, these folks the expectation is to have their closing costs paid for. So just taking the time up front to create your goals as far as, again, your timeline, your budget from a payment perspective, where you want to be is the most important one. We ask the question all the time, and we'll get a range from Hollywood to Summerville. It's
pretty broad.
150 square miles.
Yeah.
So, and there's probably 6,000 homes for sale in that. So, again, just taking the time up front, 6 months. Again, payment. What am I comfortable with out of pocket cost? What's my timeline? And your timeline is going to be based on your lease. If you got a lease that's going to expire or even month to month, all those things are really important.
Yeah, perfect. When someone hears or they see all of the headlines on the news, there's inflation, there's a war going on in Iran, and you name it, the whole landscape is pretty crazy, I guess.
Okay, sure.
Say. So when all of these things are taking place, and in many cases they're not inside of our control, how does all of that go from the headlines and what the public sees and hears to the actual transaction? What happens there?
It's a good question, and there's a lot of points to that question. I think ultimately the data can impact, again, like a war can impact the direction of interest rates, right? Which dictates timing. So a lot of times it's just having a conversation, and a lot of folks we talk to will just say, hey, my lease is up. I have this deadline.
Right.
And in that situation, it's a hard deadline. So we just try to educate them as far as, hey, if you find the right place, let us know as soon as possible. That way we can get you locked in before interest rates go up. Same thing, vice versa. Sometimes negative economic news helps interest rates. And we saw that leading up into February where interest rates hit a 4-year low.
Yeah.
So those folks who bought in that Christmas to February timeline got some of the lowest interest rates that existed in the last 4 years. So it's just, again, communication's everything in our industry. Again, like if we don't know your expectations and you don't communicate with us, we're both set up for failure.
Yeah, so you're in the dark, and then all of a sudden somebody pops back up on the radar and they want to buy, and the rate has increased to, 6.3, where it was at 6.
Exactly. It's $200, $300 a month in payment.
Yeah.
And at that point, it's priced them into a different sales price range. So again, just communicating, staying in touch is really important because, again, in the last 3 or 4 years, we've had at different times, we've had interest rates in the high 5s. We've had them in high 6s.
Yeah.
It just depends on where the market is.
I'm glad that you just brought that up. So let's kind of get into some of the myths that exist for whatever reason in this whole space.
Love myths.
Yeah. So, well, we can be mythbusters. You remember that?
Yeah, I do.
So let's kind of go into what you're actually seeing right now. And you've closed thousands of transactions and helped so many families throughout the Charleston Tri-County area to this point. And you see all of the buyer behavior before most of us actually do, right? So with that, what are some of the biggest mistakes that you see consumers are making, either inadvertently or maybe I hope it's not on purpose, right? But point being, what are some of the mistakes that you see that buyers are doing in today's market?
Just to rattle off a couple, probably the biggest myth again is making assumptions on what's required for down payment or out-of-pocket cost to purchase a house. From like a loan program perspective, our industry we haven't had this many programs since 2005 through 2008. And again, the programs range from doctor loans, construction loans, asset-based loans to 100% financing FHA loans, down payment assistance with South Carolina State Housing. So again, you'll hear the most common myth is folks assuming you've got to have 20% down to buy a house.
Right.
I mean, a lot of times, if someone has a good savings, $5,000, $7,000, again, if we can pair it with a down payment assistance program, have the seller pay their closing costs, that leaves them enough to buy a house with little to no money out of pocket, and they still have an emergency reserve. So that's probably the most common one. Outside of that, buyers making assumptions, or sellers even making assumptions on what type of market it is,
That's a
right?
big one.
Yeah, so the sellers are thinking, "Hey, my house is still worth COVID values,"
Yeah.
and buyers are thinking, these guys should be going into foreclosure any day. So again, it's a myth on both sides. And what we find historically in our side of things, which has been kind of fascinating in the last couple of years, like the average offer off list price is like 7 or 8%. But really, the average like sale to or list to sale is around 3%. So if they just got through the formality of trying to negotiate so hard with each other,
Yeah.
they're really at the same level, the goal. So again, that's another one, is just assuming that every seller or every buyer is in a desperate situation.
And I kind of want to go back to what we were talking about with the 20%. It's so common that folks think like, oh, I need to have 20% down, and I don't have 20%, but
Hmm.
20% of what? That's one aspect to
Sure.
it. But then you've also got the pie in the sky uh, dream of or needing to have a 740 credit score,
Hmm.
right? So,
Sure.
so maybe for some of I mean, whether it's a first time buyer or seasoned buyer themselves, what what are some of those opportunities for buyers today that you have? Kind of break that down for maybe someone relocating to the area working at Boeing, or maybe a nurse at MUSC or Roper St. Francis. So all of these industries are booming right now in
Mhm.
Charleston. So for those types of programs or that type of buyer, what do you guys have available?
Yeah, it's a good question. The most common one you'll hear is like South Carolina Housing Authority, and but annually they run a program called Palmetto Heroes. Those are going to be for your firefighters, your police officers, your first-time home buyers, your nurses, and great program. South Carolina State Housing Authority does a nice job as far as offering down payment assistance with really great rates. They run out of money on the Palmetto Heroes program, but they have money year round. But for just frame of reference, the interest rate on that program this year is 4.875.
That's crazy.
Yeah, so there's this commonality with again, a myth where folks are assuming, okay, well, if I don't have money down, I'm going to get a terrible interest rate.
Right.
Well, these people did 100% financing, had the seller pay their closing cost, and their rate is 4.875.
That's pretty amazing.
Yeah, they did well.
Yeah. I
So
mean, because we're in this world where so much just seems unrealistic, or it's not attainable to the masses, that
sure.
it's only, chasing the keeping up with the Joneses or whatever the case might be. But you guys are able to still get people into houses,
Yeah.
which is amazing.
Yeah, and again, like you mentioned, the opportunities here in our market, Boeing, MUSC's growth, bought them all.
Yeah.
So again, yeah, a lot of opportunity here, and it's just interesting. You always think of like the winter as the slow season. Again, the folks that bought in the winter had the lowest interest rates on the
Right.
market.
Yeah.
So
So what about, we are in a really unique area where within Charleston County, Dorchester County, and Berkeley County, and with a lot of the growth that's happening right now within, Dorchester and Berkeley County, there's the USDA loan program options that exist. What are some of the opportunities for folks that don't even know what a USDA loan is?
yeah, so USDA, again, very similar to state housing. It's for rural areas that sorry, it's for rural areas that want to promote housing or promote home ownership for folks, with income below the median area income. So it's kind of what we'd call like an opportunity program, like state housing. It's 100% financing. Again, it's going to exist in outskirts of Summerville, Moncks Corner, different parts of Charleston, in Berkeley County. It's a great program. And again, it's just one of the many programs out there that exist right now for limited or no down payment.
Right.
I mean, again, you've got 1% down conventional loans, 100% FHA loans. You got South Carolina State Housing, you've got USDA. So again, you don't need a ton of money. You just need enough money, to be able to give some flexibility as far as having, a loss reserve if you buy a house and you need to buy a couch or a lawnmower or blinds.
Yeah,
So.
just only those things.
Exactly. Yeah. No toilet paper. Yeah.
Let's talk about some of the things that people may be surprised by when they're relocating from maybe Ohio or Michigan. There are significant differences in pricing and what needs to be considered going into a loan, right? Especially if you're coming from an area that doesn't have the type of insurance policies that we require here in the area. So for some folks that may be relocating to the Charleston area, what all would they need to have together for a proper estimate for their monthly mortgage payment?
Yeah, so it's a great question. So look, Midwest, especially Ohio, Michigan, property taxes are significantly more expensive than they are here. But in a weird way, you kind of flip flop, right? Not you don't have natural hurricanes or typical natural disasters. You're not on a fault line. You're not in flood zones. So it's kind of a fascinating in the sense of you're going to move down here and be like, wow, the property taxes are incredible. But again, like the homeowner's insurance, to your point, is going to be more expensive the closer you are to the coast, especially. And then we're also in a flood prone area, so you could experience flood insurance costs. So from market to market, in a weird way, it almost boils out to be a wash. But again, understanding that those are extra expenses because, of course, everyone's eyes always go to, oh my God, the property taxes are so cheap. So again, it's just something to be aware of, but I think we do a good job of kind of setting realistic expectations up front as far as here's what our homeowners pay right now. And we have experience in the market. We're local. And it's a bit of a challenge we have with lenders that aren't in our market, like an online lender per se, where again, they're getting an estimate for $80 a year on an island that's a mile from the ocean. It's just not realistic.
Yeah.
So again, education and communication are just so critical up front between the two of us, and ultimately, I think why real estate agents really prefer someone local because they know the area, and again, it's really important to provide folks with accurate numbers. Otherwise, you're essentially wasting your time. Everyone is.
Yeah, you and I have talked a lot about that, and just hearing some of the horror stories of folks that are moving from all over the country, moving to Charleston, and they're working with a lender in, say Massachusetts or West Virginia, and they don't actually know the market here. And that has a huge impact, especially when it comes to them having confidence in knowing what the numbers are so that we can then go write an offer that's appropriate and going to win the offer to ultimately win them their dream home in their dream city. And the lenders in those cases out of state, they're not even accounting for some of the additional factors like flood insurance being needed. And then the whole game changes.
Yeah, it's one of those things. Again, to your point, like HOA fees, especially down here, some of the neighborhoods, Crowfield and some subdivisions in Mount Pleasant, Carolina Park, where they have upfront capital contribution requirements. Right. So again, another a cost barrier that folks aren't aware of. Again, if you're not working with someone in the area and they don't know that, hey, you've got to pay a half of 1% of your sales price up front. You go under contract on an $800,000 house, and then at closing, you find out you owe an extra $4,000.
Yeah, surprise.
Yeah, that's not a lot of fun.
Yeah. All right, let's flip the script just a little bit, because most of what we've been talking about so far has been buyer specific. So I know that we do have a lot of listeners, a lot of viewers that are sellers in the market or about to be in the market, or maybe they're considering it, but they don't really know what direction they should go in. So for sellers right now, what are you seeing for a seller maybe whether it's Summerville, Mount Pleasant, West Ashley, that is considering going to the market, and then kind of breaking that down and how they should be pricing considering their area or their location? Are there specific brackets of pricing that you're seeing more activity in versus others?
Hmm. It's a good question. I think a lot of it boils down to, again, like what's your, from a seller perspective, like what are you marketing, right? Depending on the area. Again, if it's one of the local barrier islands, it's access to the beach. You know, if it's Dorchester County, it's the schools.
Right.
So a lot of times, going back to what we spoke about earlier, the buyers they're struggling. This is the most expensive time in their lifetime they've ever had to buy a house or be able to afford a house payment. So again, from a seller perspective, I'm thinking more of, you know, hey, how do I price my house aggressively, but also understanding the buyer situation of, you know, hey, they can come up with a down payment, but having, you know, them giving them the flexibility to have some closing costs makes my house more marketable than someone else.
Right.
And so what we see a lot in our market is the buyer reaches out, offers, just an example, you know, a little bit below list price and says, hey, pay all my closing costs. And the seller just says no, right? There's no counter offer, there's
Yeah.
no dialogue. So again, I think one of the things that hinders our industry is the agents not being able to convey what both parties are looking for. Because what's so fascinating, again, as I mentioned earlier, is they're so close. You know, we're thinking they're 7-8% apart, but realistically, they're at the same number. They just don't know how to agree to it.
Yeah.
So I wouldn't go on much beyond that as far as if it's priced right in our market right now. It still seems to be almost multiple offer situation. If it's priced too aggressively, a lot of times that's when the sellers, we're seeing buyers offer really low ball offers, you know, 10-12% off lists. So those are just the observations from our side of it.
Yeah, that makes a lot of sense. We touched a little bit on some of the loan programs, and I want you to just maybe share. You don't have to share every single one and all of the stipulations and how you get there, X, Y, and Z, but just kind of a high level overview on what it means that there even are loan programs instead of a loan program.
Okay, sure. Well, not to do a deep dive as far as like programs and loan agencies, but you've got conventional loans through Fannie Mae, Freddie Mac, and so many loan programs are subsidiaries of the agencies, right? So your conventional loans, you're going to have your 1% down, you're going to have your 100% financing doctor loan, you're going to have down payment assistance as far as like state housing, your home ready, your home possible. And a lot of these programs are your low down payment, your 3% down, but all the way up to 20% down. So remember, conventional loans, they don't have a competitor with more than 20% down. So our industry is really good at giving creative names to loan programs, but it's really typically like one of five
Yeah.
subsets, maybe even four. So you've got FHA loans, the Federal Housing Administration, the government, USDA, again, kind of a branch, going to be your lower down payment requirements. You've got your VA loans for veterans, which is a huge program here in the Charleston area because of the naval base, or the joint base, I should say, with the Air Force. And then you're going to have your what we call non-QM loans, right? And this is the biggest growing segment of mortgage programs out there. These are going to be your bank statement programs for self-employed, your 1099 program for self-employed, your jumbo loans with expanded criteria where they only need 1 year of tax returns. So again, our industry's changed so much in the sense of, again, we have programs from so many programs from like 0 to 1% down, or all the way up to again, like jumbo loans now for self-employed with 1 year tax return. So it's pretty wild from a progressive standpoint. Like our industry has done a great job of creating different programs for the environment, for the affordability market. So I tell folks right now, if you've got a good credit score, you've got strong assets. I mean, generally, there's a program we can find for you.
Yeah, definitely.
And again, strong assets could just be a first-time home buyer with $6,000 or $7,000 in savings. Again, it's just one of those things where we're at a pretty progressive time for lending from that perspective.
Yeah, that's awesome. So let's say that, with rates with where we're at roughly today, actually about 6.3%, right?
Yeah.
So that's just our average that we're looking at. There's two sides to this. One is maybe, Matt, I don't know if I should buy right now. I just want to wait for rates to get a little bit better.
Mhm.
How do you navigate that?
Yeah, it's a tough conversation from the affordability perspective of it. So like usually when I get that comment, again, I'm asking folks, well, how do we bridge the gap now versus waiting? And the reason why, again, like if interest rates go down a full percent, it brings in an extra. It's crazy. It gives buyers an extra 10% of buying power.
That's a lot.
Yeah, but to go from rates when they were at let's just say 7.5% to 6%, we brought in like 3 or 4 million new buyers who now qualified for a mortgage. So you created all of a sudden demand.
Right.
It's basically a net negative. The rate dropped, but because demand's so high, it drove prices back up. So again, to me, you can't really provide that objection if you're serious about buying, because we got to figure out how to do it. But like how to get the payment where you want it now versus down the road. Because again, we had folks during COVID who were like, I'm just going to wait this out. And now obviously home prices are drastically higher. So what we want to do is sometimes you truly need to wait. Like, hey, I need to save more money, or hey, I need to make sure that my job is more secure. In those situations, totally understand. But it's an objection we try to be careful with, because again, we oftentimes see that rate drop, and then that payment is just as expensive, if not more expensive, a year later, 2 years later.
Yeah, as a result of the prices being impacted because of the demand.
Exactly.
Yeah.
Yeah.
So if somebody wanted to wait and it's, well, wait for what? Well, I want to wait until rates are at 5.9%
Mhm.
versus the 6.3 that we see just today, right?
Mhm. Yeah.
So I don't know, let's say maybe it's a $400,000 home, and we're looking at, we don't have to get in the weeds on the numbers, but
Sure.
just roughly speaking, what would someone's actual monthly payment change by if they were truly waiting for 6.3 to somehow get to 5.9?
Yeah, so about $120 difference in monthly payment.
That's it.
Yeah.
$120.
Yeah. And so just remember again, like home value or monthly payments change by $100 a month per, or $60 a month per 10,000. So again, if the home price went up 15, $20,000, all of a sudden that $120,000 savings is gone. So it's just one of those things with again, the supply is so short and the backup demand is so wild. It's going to be, inventory is going to be a challenge we're going to deal with for a while.
Yeah.
Yeah.
Yeah, I saw we're, what is it, 10 million homes short
Hmm.
based on what the White House just pushed yesterday, I think.
Yeah. So like the millennial demographic is now larger than the boomers, and obviously the boomer generation, a majority are homeowners. So you have this just massive pool of buyers. So eventually inventory will catch up, but it's just a slow burn. And it's just difficult because every time we get that rate drop, you get the demand increase, and then it's a net negative.
Yeah. So if, somebody is knowledgeable and they're educated around the numbers, the choice would be to not wait, right?
Exactly. I mean, if you can afford it now, and it's a place, again, I remind folks like you don't want to buy a house if you think you're going to be there for 2 or 3 years.
Yeah.
Values don't always go up. Sometimes values come down, or sometimes they're just stagnant. So, but to your point, yeah, if homeowners insurance, home ownership is important to you, obviously, the statistics show how much more money a homeowner has over the in net worth over a renter.
Mhm.
It's dramatic.
Yeah.
So
A huge difference.
yeah. So again, if the time is right, pull the trigger for sure.
Yeah. I mean, the best time to plant an oak tree was yesterday,
Yeah.
but the second best
Exactly.
time
Yeah.
is today.
Right.
So if somebody knows these different aspects, and I guess this kind of goes into the second side of my question with all of this, is Do you see, or when do you foresee the opportunity for somebody to refinance if they say, okay, I'm going to go ahead and plant the oak tree today,
Hmm.
and they're going to take advantage of the 6.3% rate? When could they refinance?
Oh, it's a good question. It really depends on the loan program and how much equity they have in the property. We heard the old saying, like, was it own the house but date the rate?
Yeah,
It was kind of corny, but
I love it though.
yeah, yeah. Again, now like ownership isn't always necessarily building the equity quickly. But in theory, you could qualify for rate and term refinance after 6 months if rates dropped, if you had the equity, or you could afford to pay the closing costs. So again, a first-time home buyer doing 100% financing is probably going to be 4 or 5 years.
Yeah.
But if you bought a house, put 5%, maybe 10% down, pretty quickly. And like a good example would be, interest rates in October of 2023 were approaching 7.8%. Speaking broadly, February 2026, like 5.99, 5.875. So almost a 2% improvement. So again, for those folks who bought, good for them. Like they took a big gamble. What a lot of people think is a big gamble, and it worked out well for some.
Yeah, so some folks they can already refinance and be in an
Mm.
even better position now. But aside from that, I mean, even if we still pace for a 1% appreciation or 2% historical average to three, something in that ballpark, I mean, even if they got in at 6.3% and we still in the 5 year window, we see some more appreciation take place, doesn't that mean that if the value price of their property increases, they have a larger equity stake at that point?
Yeah, absolutely, and that's really what it boils down to. Is again, I think you hit the nail on the head. Is folks got to remember, every year you're paying down the mortgage little by little, and every
Mhm.
year the value's trickling up little by little. It doesn't. The whole COVID era was just
Yeah,
craziness, but
huge boom.
at the end of the day, it's kind of like a snowball going down a mountain. It starts, year one, and then by year 10 is a pretty significant amount of equity that you didn't have before.
What are some hacks to even fast track your equity position? Because I've heard some out there that, if you make even just one extra mortgage payment a year, it can have an impact on your, I guess, the lifetime of the loan.
Yeah, so the theory, it's kind of like a bi-monthly payment is what it kind of works out to be. So one extra payment a year mathematically cuts almost 7 years off the life of the loan.
That would, hypothetically speaking, that's on a 30-year fixed rate.
Exactly. And so in theory, you could pay two extra payments a year and have the house paid off in 16 years. So again, great hack if you can afford it. I tell folks, like, the whole premise of the biweekly is just to pay a little bit extra every month. That's fine. Or you could just do one lump sum, just take $100, put it in an envelope, and then when you get
Yeah.
there's no right or wrong there. But I'd say also considering like shorter loan terms, if you can afford the payment, you'd be surprised for like a $300,000 loan amount. The difference in monthly payment between the 30 and the 25, it's probably, and I'm speaking broadly here, maybe $200 a month. The difference between the 25 and the 20 years, probably another $100 a month. So for $300 extra a month, you cut off,
Yeah, it's huge.
10 years of your loan. So again, it's one of those situations where like we buy the house and we want to be in the house, but don't forget about the math behind the house.
Yeah.
We exist because our industry makes money on
Right.
people, carrying the loan longer. In theory, if they can afford it, that's not ideal.
All right, Matt, last thing. So outside of all the numbers and the stats, the data that goes into all of this and what you do, what's the most recent outstanding moment that you can think of with a client success story?
Yeah, we have a couple every year. Yeah, again, we're always honored when folks decide to work with us, and it brings you great joy to help people own a home. It's pretty wild career path, but it's kind of like golf. There's 4 or 5 every year that you remember. And more recently, we've had several people that were the first generation homeowner in their family history, which is pretty wild. They, again, no one in their house ever owned a home. So to be able to help them was super cool. And again, other folks, sometimes it's just finding their dream home. They a lot of times, like it could be a move out family. They had the house with 2 kids and 1,100 square feet and one bathroom, and they saved and they saved, and finally
Yeah.
they got the house with the extra space. So, like that kind of stuff is probably the most rewarding. But again, like we're so grateful for everyone that works with us because again, it's such a huge amount of trust you place in us, and we take it as calm as we look. We take it so very seriously.
I know you do. I mean, you guys are in here. You specifically. I mean, you're in here some days before 6.
Yeah. It's I'm here more than I am at my home. So,
all right, Matt. Before I let you go, we're gonna do a little quick rapid fire here, just short answers only. All right.
okay.
All right. Best Charleston restaurant.
Halls.
Halls.
Yeah.
Good choice. Favorite beach in the Lowcountry.
Kiowa.
Kiowa.
Yeah.
First home you ever bought.
James Island.
On James Island?
Yep.
Really?
Seaside Plantation.
That's awesome. What about the next big thing or big move that you're looking for in this market?
Probably inventory. Again, we were kind of creeping up for the last couple of years. We're sitting around like 3,400. Now we're looking at low 5,000s today. I'd love to see us return to like some sort of a healthy market with like 7,000-8,000 homes. I know we should have like 20,000, but just to get to like our historical norm would be fantastic.
Perfect. Well, Matt, this was absolutely fantastic. I really appreciate you spending some time with me and helping everyone who's either listening or watching learn a little bit more about the truth behind the truth and the reality behind the real estate economy, the lending economy, and just everything overall in Charleston. So for anyone who wants to connect with you, learn more about their options that are the best fit for them, what's the best way that they can get in contact?
Yes. So probably just shoot me a text on your email. Let's set an appointment time. And again, go over that hopes and dreams call. Let's figure out what your goals are, what's important to you, what motivates you, and then figure out based on your financial situation how we arrive at that goal. And then at that point, we'll hand you back over to your real estate agent and find you what you're looking for.
Perfect. Well, thanks so much, Matt. And for everyone listening, if you found any bit of value in this conversation with Matt Mieras, please go ahead and share this with a friend, family member, somebody that might actually be able to benefit from what you've learned and help them connect all the dots all together. And that's a wrap. We'll see you on the next episode of Ask Charleston. I'm Brett Kelley. This was Matt Mieras.
Bye. Good to see you.